Hi everyone, welcome to Tookitaki's webinar, The Next Normal for AML Compliance in Digital Age. I am Abhishek, founder and CEO of Tookitaki. We are a global RegTech company providing machine learning powered end-to-end AML analytics for financial institutions. I will be your host for this webinar. I want to kickstart the conversation on the topic about how increased digitization has influenced various businesses and brought in a paradigm shift in the way business approach growth opportunities. Moving away from conventional transactional modes such as cash and checks, banks and financial institutions across the globe are increasingly adopting digital means of payments. Technology has paved way for many digital payment methods such as prepaid cards, mobile payments, and internet payment services. While these payment methods enhance the ease and speed in which funds are assessed, what has also opened up is new avenues for fraudsters to abuse the financial system. Today, banks, irrespective of segments, are facing AML risks of varied complexity, such as suspected use of open loop cards, online payment systems to launder drug proceeds, laundering of illegal gambling proceeds through prepaid cards, use of crypto exchanges. So while clear regulations are there to address these emerging AML risks, but proper you know, explanation of these regulations are still yet to come. Hence, financial institutions are always in the fear of unknown. Today in this webinar, we will take our audience through the market transformation in this payments ecosystem and talk about the AML risks which can be detected proactively and mitigated through tech-enabled transformation. That being said, let me introduce to our panel of industry experts. Meet Dustin Palmer, who has been over 17 years of experience in the legal, corporate, and financial services industry. He currently serves as the Managing Director and Head of Financial Crime Compliance Practice at Promontory. Dustin previously worked with the US Department of Treasury as Senior Advisor, guiding on legal and policy matters across sanctions, financial crime enforcement, AML CFT, and foreign investment in the US. Joining Dustin and myself today is Nikhil Agarwal from Promontory. He's serving as the Managing Director and Head of Analytics at Promontory's Financial Crime Solution Center. Nikhil has more than 18 years of experience as a data and analytics executive within consumer and corporate banking segments across FinCrime space. Prior to Promontory, he was associated with global reputed banks like Standard Chartered, Bank of America, DBS, and Citi in various senior roles related to compliance. At this time, I'm going to turn over to Nikhil, who will get us started. I would request all our audience to have enhanced participation because that would allow us to make this session more interactive. We will have a dedicated Q&A session to answer all the questions that come up during the webinar. Over to you, Nikhil, to get us introduced to the evolution of payment ecosystem and the impact of AML CFT of now and beyond.
Thank you very much, Abhishek. If we could go to the next slide, please. Let me start off with more the macro view, the topic of digital banking, new payment methods, and from a broader lens, digital transformation is not new. We've seen the launch of new products, an uptick in adoption over the last 10 years. What's different in today's context is that banks, FIs, and hyperscalers like Apple, Google have accelerated their focus on digital. In terms of the priorities, number one, ensuring that the customer experience is surpassed, exceeding on all expectations, making sure that every interaction is a seamless experience. You want faster payments, you want faster clearing. Second, in terms of the topic of focus, managing costs, what we are seeing in the COVID era is that branch footprints are no longer relevant. Post-COVID, we should be expecting branch footprints to be decreasing as much as 50% because banks are realizing that they don't really need this physical presence. And third, as Abhishek has already mentioned, from a risk landscape, this has brought about an increase in compliance expectations, certainly in terms of the emergence of new risks. I know that Dustin will get into the regulatory aspect, but I did want to share one key observation that we are noticing across banks and financial institutions, and that's the breaking down of silos within the risk organization. New payment methods have brought about anti-money laundering CFT risk. It's brought about sanctions risk, fraud risk, cybersecurity risk. And what we are finding out is that there's really an integration and interlock in terms of how these risks are investigated. Now, certainly machine learning makes this intersection of risks more prominent, more measurable, and Abhishek will certainly get into that. Now, this slide talks about really the shift in the industry, and we've broken it down into 3 time periods, particularly from the stance of adoption, from the stance of new products being launched. So the first window is really the 2012 to 2015 period, where we saw a surge in terms of the adoption of credit cards, debit cards, and even payment cards. And this was the period that Apple Pay was launched. Now, just from a magnitude perspective, it's important to note that, for example, debit card transactions increased to 60 billion, and this is a 59 times increase over a 10-year window. We saw that in terms of prepaid cards, almost 10 billion transactions. Certainly, this brings about risk that needs to be measured. Now, moving on to the second time window, 2016 to 2019. This was the era of mobile payments, and certainly the launch of P2P services, including Zelle, including Venmo. And it's again important to appreciate the magnitude. From a non-cash transaction perspective, we were at a 2-decade peak. We're talking almost 540 billion transactions. Now, within the US, we hit almost 100 billion in terms of payment transactions. And in this window, that was a 10 times increase. And certainly in terms of when you look at the overall global payments industry, revenue hit a staggering $2 trillion. Now, coming to today in terms of COVID, now we're certainly seeing a change in consumer behavior. You have stay-at-home orders, and what has this meant? It's meant really, e-wallets, contactless payments, are in vogue. You look at Walmart, 100% increase in e-commerce sales just in the second quarter of 2020. You look at in the US, Dick's Sporting Goods, blockbuster sales because everybody suddenly wanted, a home gym. You look at Target and other retailers. Now, again, when we look at the top 4 US banks, we're seeing the penetration of mobile banking at an all-time high, with 3 in 4 customers actively using mobile banking. And specifically, when it comes to Apple Pay, 5% of all global transactions have been handled by Apple Pay. And if we were to look at the future projections that are being made, 1 in 10 payments globally will be made using Apple Pay by the time we hit 2025. So it's quite clear in terms of this particular slide that there is this exponential increase in terms of new payment methods, both in terms of volumes, in terms of values, in terms of global presence, and we expect to see this macro trend continue onwards. Next slide. Important that we now shift to the AML context, and there are a number of interesting statistics on this page. So I'd really like to take you through them one by one to kind of give you a sense of where do these new payment methods fit in when we talk about money laundering from a global perspective? So the key statistic that is the headline is in terms of money laundering, the scale, as has been published by a number of organizations, including the UN, stands at $2 trillion annually. Most of us are familiar with this number. But what's important to note is that these new payment methods attribute to about 200 billion of this larger number. So we're really talking about the 5 to 10% increase in terms of annual money flows attributed to new payment methods. The left-hand panel talks about the number of SAR filings that were attributed to new payment methods. And again, this data is coming from FinCEN. The reason we put this over here, and we recognize that this is only data till 2019, is to kind of show you that in the last 3 years, 27 to 2019, SARs attributed to new payment methods were fairly flat. But once we do get the data for this year and beyond, we are pretty sure that this number will likely hit at least to the 20% range. Now, how we know this? When we look at the AML fines that have been levied just in the first half of 2020. Now, this has hit $706 million. And believe it or not, this is 60% higher than all of 2019, when the aggregate fines were in the 444 million range. Again, this is shows you the magnitude of where we are in terms of projecting out to the end of the year. I thought it very important to balance out some of this macro view with interesting stories about 3 AML fines specifically pertaining to new payment methods, and these have all occurred in the last 5 years. The first is about a virtual currency exchange. This is the Canton Business Corporation. Now, they were fined $110 billion. They permitted transactions in Bitcoin, Litecoin, NovaCoin, Dash. But what's important to note over here is that not only was the institution fined, but one of the central operators was jailed in Greece, and he was personally fined $12 million. So there's certainly individual liability when it comes to violating the broader AML regulatory context. The second case is equally interesting, and I need to refer to my notes because this is the Merchant Bank of California of Carson. Now, certainly this regulatory order was broad sweeping, but there are a few things to call out. First, there was a lack of due diligence in terms of foreign correspondence, and second, there was really no detection framework or reporting framework when it came to suspicious activities. Now, again, these were explicitly called out by FinCEN. And the third pertains to PayPal, and this is centered on sanctions risk. Remember now, we spoke about the interlock of the different types of financial crimes, and this particular order is interesting because it talks about PayPal and how they processed transactions pertaining to sanctioned countries. So let me give you a sense in terms of numbers, and you'll appreciate why this is important. PayPal processed 33 transactions totaling $3,300 that violated Sudan sanctions. So we're talking $100 per transaction. In the case of Cuba, PayPal processed 98 transactions totaling $19,000, so on average $198 to $200. Now, we certainly recognize that in terms of these new payment methods, we are talking about the magnitude of transactions has really ramped up the volume per transaction in terms of the dollars is quite low. So in terms of this velocity, it's important to keep in mind that we are going to need new detection mechanisms to really for example capture microstructuring typologies. So okay, let me now hand over to Abhishek, who's going to speak about detection and how it fits into new payment methods.
Thank you, Nikhil, for your insightful presentation. Can we go to the next slide, please? Okay. So before I start talking about this specific slide on Tookitaki, let me first set the context. We all realize that the customer behavior is indeed changing, and financial institutions need to expand their capabilities of digital operations, which we all know would allow them or kind of improve their or increase the risks of various AML situations. Now, what we have to also understand, right, and what we have seen working with financial institutions, that any tech-enabled transformation that financial institutions capture, which is kind of ad hoc compared to transformations that they're doing through an end-to-end system, almost provides them twice value than the ad hoc processes or systems that they do. So for instance, if they're bringing in a simple upgrade, or they're bringing in a point solution to solve one little problem, rather than not doing a larger transformation, they are kind of losing out. So the approach that Tookitaki as a system that we have taken, we have created an end-to-end AML analytics, which is not only helping them create value in the AML process, but also creating a larger transformation value by connecting the ecosystem in making those decisions happen. And today in this slide, I want to talk about that if banks or financial institutions really want to make or bring about a digital transformation, they need to move away from siloed approach and create a more collective ecosystem to make that transformation more powerful, more effective, and more scalable. So introducing Tookitaki. So what is Tookitaki as a system offering? So what Tookitaki as a system is offering is a package where we have a concept called as a typology repository, which are essentially a library of globally curated typology patterns, which is continuously growing. And these typologies can be seamlessly ingested into our automated machine learning solution, thereby providing a continuous, relevant, contextual approach to make sure that new cases are always detected and providing the banking ecosystem a much more covered AML risk solution than any existing ad hoc solution that exists today. So essentially what we are saying, we are kind of combining the typology repository and our automated model management to detect miss cases, or rather to detect these sort of new cases and provide a complete end-to-end compliance solution to our clients and into the broader ecosystem. So let me spend a couple of minutes talking about the typology repository and what does that mean. So essentially, typology repository management, which we call as TRM, is a federated learning ecosystem that kind of combines collaborative decentralized learning across multiple financial institutions, regulatory bodies, consulting companies in a privacy preserved manner. So how do we do that? The way we do that is we have created these sort of typology patterns, which does not contain any client information, does not contain any rules information, and these are kind of stored into this library. Now, once these patterns are stored into this library, these patterns can be seamlessly ingested into our automated model management system to provide value. Now, a lot of the times, our financial institution asks, like, what does that pattern basically mean? The patterns are essentially an aggregation of multiple touch points of customers, which kind of replicates a AML typology situation without sharing any personal identifiable information and without any threshold. Now, this is important because this creates a system in which financial institutions can share data without having to worry about privacy or any security related information. This AML typology pattern currently has typologies or patterns around geography, products, customer type, techniques, and predicate offense, thereby providing a very holistic coverage to our customers that onboard the system. Now, the question which a lot of people ask us, now you have this typology repository, which is an overall, understanding of AML coverage, but how does that relate back to your AML system? So in Tookitaki's environment, we have created this patent pending technology, which can pull out or ingest this typology using this sort of distributed learning framework, automatically able to create an optimized machine learning model and allows to detect these cases which the typologies generally represent. So the entire process, which would have taken 500 to 800 hours of model building exercise, can be seamlessly done in less than 1/3 of the time. And this process can be followed across not just in the model building, but also in the training as well as the continuous monitoring framework as well. So essentially what we are saying is that using the overlaying technique of advanced machine learning and AML patterns, we are able to detect these sort of new cases accurately and through a scalable fashion. Just to share some numbers, for one of the banks that we are currently in a technical production, we are able to almost create a 5% lift in their SAR filings by detecting those new cases, which they would have completely missed out if they were not using a system like us. Now, if you can go to the next slide, please. Yeah. So I wanted to, kind of relate back to a topic of NPMs and non-payment methods. So what I wanted to talk about is, just wanted to share to the broader audience some of the recent cases of money laundering situations that resulted from NPMs. And specifically, I just want to talk about the first one, which is the one which is in 2020 related to digital currency or crypto. Almost $1.36 billion was actually money laundered, specifically in terrorist financing possibility. So what was that case? That case was essentially a customer of this specific crypto exchange was an MSP, which is a money service business. They were based out of Turkey, and it was actually getting funds from non-profit organization from the North American markets. The crypto assets was partially transferred to a retail company in Turkey, and there were almost 250 individuals who were actually pushing those assets across various regions of the world. The retail company further was sending out funds back to the crypto customers in various ways. What Tookitaki did, this typology was created into a repository by one of the AML experts, that we have. And once these sort of typology was created, it was seamlessly ingested by our automated machine learning model, and we were able to decode this case and lay it down to our to our clients, to our partners, and showcase the value. Now, what I would like to do is demonstrate through a small 2-minute video of how easy it is to able to create new typologies in the NPM space and then detect these cases seamlessly, taking almost less than 1/3 of the time, which would have been taken if you have to do manually through data science, custom data science and analytics method. So if you go to the next slide, please, and see if you can start the video. Oh, good. So what we are showing in this slide is, this is our topology repository management. It has few of these sort of crypto topologies. It is moving quite fast. Thank you. I hope that people were able to get a glimpse of what the video was. But just to sum it up, what we essentially showed was we showcased few of the topologies on crypto and non-payment methods in our topology repository. We showcased that there was a specific crypto topology which was related to the 2020 case. There is a user interface where you can create these sort of topologies without any threshold or customer information. We showcased that how financial institutions can quickly download these crypto topologies in our machine learning model, and the model automatically creates these, takes these topologies, converts them into input parameters for the machine learning model, and this is automatic process. And once that's done, it can be applied on any data of a financial institution, and it is able to detect certain case. Now, the last part of the video, we showcase that we provide a complete contextual explainability in form of a narration where the exact rationale was displayed for investigation team to make it more effective along the way. So I just want to, just highlight one point here is that what we need to do when these sort of new payment methods are coming, we need a new paradigm shift way to kind of analyze these sort of new techniques. We need a mechanism to kind of convert these techniques into actionable topologies which can be used by the system, and thereby being able to cover the AML risks that is there. So if you go to the next slide, please. Okay. So I just want to spend a few minutes before I hand it over to our next guest speaker is that I want to say that what we are seeing now is that time is now to drive tech-enabled transformation as financial institutions and working with multiple FIs along the world in globally, we have seen that most of the financial institutions are starting to take their data transformation journey. They're creating a strong foundation of data hygiene and soundness. They're creating data mapping extraction processes. So they're actually taking measures which help accelerate adoption of machine learning models and facilitate data validation and governance process. So the process has already started. Hence, we believe that this is a right time now to onboard innovative technologies and kind of provide the AML risk coverage that is required in this new environment. Now, I would like to hand over to Dustin, who will walk us through the current regulatory landscape, especially in the NPM space, and also share his perspective on the strategies that financial institutions can adopt for tech-enabled transformation. Over to you, Dustin.
Thank you, Abhishek. I find what Abhishek and Nikhil, what they explained to be fascinating for various different reasons. I think, the biggest reason might just be that there's such a significant disruption in behavior that's happening right now. I've been approached by various different financial institutions where they have said that with these new payment methods, they're actually not monitoring at all because they don't know how to do it, or the dollar amounts might be so small that they're not sure what to do. And it's just fascinating. Now, obviously, many banks are trying to figure it out. I'm not sure all of them are actually figuring it out, but they're trying to figure it out, and they're moving forward with that. So if you could move forward a little bit to the next slide, we'll talk a little bit about regulations. I'm going to get into the specifics of the different mobile payment services, virtual currencies, and internet payment services in just a minute. I do want to talk a little bit about these changes. I think 2020, has really turbocharged those changes in addition to everything that Nikhil has explained. And honestly, it's hard to keep up. I've even seen in some financial institutions, they've moved some money laundering resources over to fraud to keep up with the extensive fraud that's increasing. And it's even new fraud, and they're trying to find those new typologies in the fraud space. Now, that's not true for all money laundering spaces. Like, cash usage has dropped a lot, so those detection scenarios honestly hardly even work in many institutions. And these sort of new payment methods areas, those continue to increase. So I'm totally with Nikhil here, where he's thinking, yeah, those are going to continue to increase dramatically within 2020. That's what we're seeing anecdotally within the banks. Obviously, we'll see what happens shortly. But really, the point I want to point out is it's hard to use these classic static detection scenarios for the new payment methods. Why? Well, the NPMs are only increasing. You have global use of cell phones, changing buying patterns, especially during the COVID crisis right now. There's increased mobility, change in traditional banking models, changing demographics, a lot of new options. Apple, Google, Amazon, Facebook Pay, everything. Fintechs are making things faster and easier. And as I noted, cash is decreasing. To the specific laws and regulations point, they really haven't changed that much. The anti-money laundering, the know your customer, the sanctions laws are the same. There are really no safe harbor or carve-outs. That being, for example, the travel rule has just been, reaffirmed by FATF and by FinCEN here in the United States, that it applies no matter what. It applies to cryptocurrency exchanges. It applies to everything. And now there are, limits, $3,000 limit, for example, but you still have to include all the same information, which cryptocurrency exchanges are having a hard time following. The SAR and STR rules are the same, although there are some limits to those, but those still apply. Notably, and I think this is really important, the broad definition of a financial institution and a money transmitter have been sort of reestablished. Let me give a good, real example from last year. In April of 2019, FinCEN penalized an individual, I think for the first time, for failing to register as a money services business because he was facilitating cryptocurrency exchanges. So he described himself as a peer-to-peer virtual currency exchanger, and this guy, Eric Powers, he was fined after failing to follow the money transmitter rules and for not filing the CTRs, the currency transaction reports, or the SARs for about 200 crypto transactions, which valued about $10,000, various years ago. And the director of FinCEN came out and said, look, obligations under the Bank Secrecy Act apply to money transmitters regardless of their size. It wasn't the first time that regulators had targeted cryptocurrencies, as Nikhil noted. But what I think was happening is he was reaffirming, look, the laws and regulations apply to everybody, and we're going to make sure that not only those groups but also the banks are complying with these laws. So that's important, and I think what that sort of said to a lot of my clients in the banking industry is third-party oversight is really important, right? It's stronger than ever. Record keeping and screening and these different types of requirements are still in place, even if you're using non-traditional methods for payments. And I think this increases the need for things like real-time escalation for the enhanced fraud and money laundering detection. And new and different typologies, as Abhishek was just explaining. And you have to be able to deal with situations when all the information is not there. I would say, and maybe even more important than money laundering sometimes is the sanction screening side of things. It has to happen. It has to be real time to be able to capture that information. There is no dollar threshold on sanctions violations. And honestly, a lot of false positives with these NPMs. It's a big deal because it can slow things down. You don't want a payment being stopped just because somebody is buying a Cuban sandwich. And so you sort of have to come up with a solution to that. In that regard, I sort of think about it as a, how do we solve that problem? The same rules apply, but the world's changing. Well, I'll get into this a little bit more, but luckily those laws and regulations are risk-based and flexible, right? Importantly, the regulators have not said that there are a specific number of detection scenarios that must be used. Rather, the rule is that financial institutions must find suspicious activity and then file it, right? And so you must find that suspicious activity. There's not specific KYC information beyond the basics that needs to be gathered. Rather, you must know your customer, right? So these are principle-based rules that are in place. And I think most importantly, you must follow the data, right? And this is vital. And as Abhishek talked about, right? You must do your due diligence on the NPMs. You must gather information, use technology to find and report that suspicious activity. And that's just key to all of that. So let me talk about the three examples that are on this slide here. Mobile payment services, right? Oftentimes these are restricted to banks. Either way, all the parties are required to comply with the AML and sanctions requirements. So simplified due diligence is often a possibility and wise based on an appropriately calibrated customer risk rating model. Limits and thresholds can make the suspicious activity monitoring program, the KYC, and other programs much more efficient and effective, and should be a lot of focus there. There's certain risk, like I noted, with fraud and sanctions that remain high due to non-face-to-face transactions, which is the way that these are designed. But the low dollar amount or the low currency amount, do cut against those. But smurfing and other typologies are happening more and more, and that's sort of the key to the machine learning, is they can recognize the typologies before we do. I oftentimes hear about it once the bank's already figured it out, and after thousands, if not tens of thousands of those transactions have already come through. The second area, deals with virtual currencies, and I've already talked a little bit about those. Here, I think throughout the world, and especially last year, a lot of regulators made it clear that virtual currency exchanges, et cetera, are money transmitters. As we discussed, mixers and blenders make tracking coins a lot more difficult. This is why the need for data and analytics is key in this area. It is really hard, even with coins that are not anonymous or even pseudo-anonymous. Data and analytics are key to being able to search for, find suspicious activity and report that. A lot of financial institutions, for example, are relying on their extensive due diligence of the third-party exchangers and sort of creating white and black lists and sort of doing and using that due diligence as a good mechanism to enhance their programs. Finally, the internet payment services, Apple, Google, Facebook, Amazon Pay, et cetera. They're not always financial institutions or money transmitters, depending on the jurisdictions. Some do require registration, but they have a decent amount of information, so they can do the sanctions and transaction monitoring sometimes, or that information needs to flow through. And again, notably, like I said, the financial institutions still have the same obligations for everything that flows through them. So, my point is always, don't let your guard down, even with these small peer-to-peer payments. If we can move on to the next slide, I want to talk a little bit about, how I view it, as someone who's been in the legal and financial compliance space for 17 years. What should we do now in this new environment? A few thoughts. Number one, I think it's a perfect time to truly strengthen yourself as a financial institution, right? First of all, gather data and build strong processes now. Second of all, enhance technology with a focus on analytics, not just new systems. A lot of financial institutions make the mistake of thinking that just buying a system off the shelf will just solve all their problems. It doesn't. Focus on the analytics. Find someone who you can partner with in that analytic space, because the one thing that for sure will happen is there will be more change, and you need a system that can change with you, or an analytical program that can change with you. Further, I'll talk just briefly about this in a moment, but enhance that data and the technology through utilities and consortia, right? This sort of the ultimate goal is to get more information, to have the information you need to know if something is truly suspicious, or if you should have that customer as one of your customers or not. Sort of the best way to really partner with leaders in the industry. A lot of people will ask me though, why now? How is now the best time? Honestly, again, I've been in this space for about 17 years. I've never seen a better time to innovate. Not just because we sort of have to, because of the speed at which everything is changing in the world, but the regulatory environment is actually very amenable to change. The regulators in the United States, OCC, Fed, FinCEN, and others, the FCA in England, and many others are very, Singapore, MAS, and others are very open to new technologies, and are expressly telling financial institutions to use sandboxes, to try out new methods, and they're giving financial institutions the flexibility that they need in order to do that. And honestly, the regulators know that financial institutions are struggling, and they need the information more than you do. I mean, the ultimate user of a suspicious activity report is law enforcement, and so they're giving us all that leeway that we need. Also, given the current economic environment, there's really no luxury for thousands of extra false positives, right? We need to focus on better data, processes, and technologies that can help save money and improve the program. Another reason I thought of is, honestly, a lot of others are doing it, and you don't want to be left behind. There are many large banks with giant compliance costs, so they have a big incentive. They know that this is the way forward. They know that this is what they need to do. And honestly, the regulators are joining in. If you look at Singapore and the blockchain KYC utility, the Eastern Caribbean group of 8 different countries out in the Caribbean are getting together so that they can use more data and technology in order to enhance their transaction monitoring and KYC. Scotiabank is consolidating its services into one location in order to enhance its efficiency and effectiveness through data and technology. The Cayman Islands is creating a beneficial ownership registry. And ultimately as well, speaking of utilities, they're becoming much more common. As I noted about Singapore and the Eastern Caribbean, there's some utilities that are being formed there. There's some various private utilities that are being formed. I know there are at least 2 groups in the United States, a large bank group and a mid-sized bank group, that are trying to organize themselves and share data and information. And also this shares the cost and the use of the technology so that multiple banks can use it all together. In Scandinavia, the various Nordic banks are trying to put together a KYC and a transaction monitoring utility. And I've seen it myself with a proof of concept where they've demonstrated how much overlap there is between the customers so that they can improve the customer experience on that information. But also when you have that much more data, plugging that data into a system like Abhishek was describing, you're able to really recognize and find those types of typologies and significantly enhance your suspicious activity monitoring program. If you'll turn to the next slide, I'll give a few concluding thoughts as I thought about this. First of all, market transformation in the world of payments and digital currencies has already begun. The challenge is now on the financial institutions to remain key players. I think that's where regulators want us to be, and I think that's where we will stay. So there is an expected increase in regulations, or at least a focus on these new payment methods, and a focus on financial institutions to be able to identify the new typologies that are out there, to be able to identify the money that is being laundered or the fraud that is happening. And that leads to the third, and I think very important conclusion. It's in today's world, it's essential for financial institutions to adopt the machine learning technologies and tackle those new and emerging AML risk and maybe sanctions risk arising from those fundamental changes in the market. And ultimately, like I said, there might be private partnerships and consortia, might be a public-private partnership where you're actually partnering with different regulatory groups to strengthen the financial institutions as we all adapt to the changing customer behavior and combat what we're all here to do, which is combat the money laundering, the terrorist financing, and the other violations that are out there. And with that, I will turn it back to Abhishek.
Thank you, Dustin, for sharing your thoughts. Nikhil, before we move on to the poll, would you want to add any points to what Dustin mentioned about the conclusion
Yes.
thought that he talked about?
Absolutely. And let me answer this through the context of a question that one of our participants asked, because it ties in really nicely. The question speaks to the increasing interconnectedness between evolving new payment methods, traditional payment methods, the whole sense of worldwide operations. And the question asks about how should we be thinking about this? Is it about scenarios? Is it about systems? Is it about investigations, or some combination? So first off, this is a great question, and it certainly ties into some points I wanted to make. When we think about new payment methods, when we think about traditional payment methods, recognize that these are not mutually exclusive. Think about it from the perspective of a Venn diagram, and we are equally interested in terms of that intersection. Now, in some cases, particularly with Gen Z types of clients, there might be minimal overlap. But let's say when it comes to Gen X, Gen Y, I do think that that intersection is populated, where there will be clients who will be using a combination of both traditional and newer payment methods. Now, in this case, there are a few thoughts I have in terms of how should an institution be thinking about this, and it really builds on the point that Dustin made about the whole risk-based approach. Certainly, your existing set of scenarios is going to be incomplete. You might think about changing and altering a structuring scenario and coming up with a microstructuring scenario that focuses on the burst of payments. You're going to have much lower thresholds in terms of dollars, but much higher in terms of the number of transactions. Now, this is certainly one lever, because it's going to be focused on making sure that you stay relevant. I also want to connect it to what Abhishek was speaking about in terms of the evolution of typologies. So there will be a need in terms of playing in that sandbox and thinking through what are going to be the new sets of typologies, particularly those that pertain to velocity, those that pertain to that set of frequent counterparties that an individual or an entity might be dealing with. So that's going to be necessary in terms of making sure that we have continued coverage. Also, from an investigations perspective, keep in mind that your investigators really have that ground knowledge, and oftentimes they're able to spot patterns in the data that we haven't quite codified yet in the form of a formal typology. So particularly when it comes to transaction reconstruction, when it comes to, for instance, looking at the web of counterparties, investigators build out a hypothesis, and either they prove it or they disprove it. And I think that there is significant value in terms of these ad hoc investigations. So bottom line, it has to be a multi-pronged effort in terms of certainly looking at these evolving risks, understanding and better structuring the data, looking at guidance in terms of new regulation, and certainly this whole interconnectedness from both a detection sense and also from that investigator sense. And over time, the more learnings that you generate, the more you're able to stay ahead in terms of the bad guys.
Thank you, Nikhil, for your thoughts. I think it's time for a poll. I would really request our audience to mark your answers for the question that would come up on the screen. You are allowed to select multiple options. This poll will run for a minute. Please answer them. We have received multiple questions from the audience, and thank you so much for being interactive. As we continue the poll, I will, kind of open up the Q&A session, which I would like to start with Dustin. Dustin, the first question that we got from one of our audience is, it says the disruption of the digital payment landscape has changed the consumer transaction behavior. As AML risk experts, what would be your recommendations to financial institution to tackle cases around the NPMs that we are talking about today?
Yeah. So this is honestly the big question, right? In other words, what to do with these NPMs, what to do with the with the dramatic change in behavior, and I think the behavior will either is change for good or just continue to change going forward. So my initial thought is you've got to analyze the change, and what does that typically mean? Well, in the past you would maybe do a distributional analysis. You look at what the different customers were doing, or maybe even segmenting the customers into groups and taking a look at them. And I think that still applies to a certain degree, but I think that only gets you so far. I think you can do that. You can analyze it, do some distributional analysis, look at what's changing, does it make sense? And honestly, depending on what you see, that would determine what type of methodology you would use. For example, and again, just sort of placing myself, a little bit outside of the advanced systems that Tookitaki and others offer, you depending on what you see, you might try to use some clustering technology, right? So you take clustering and you try to put people into different groups, and then you do some non-supervised machine learning so that the machine can try to recognize which groups are acting like each other, which groups are engaging in similar suspicious activity, and which groups are engaging in normal activity in this new world of NPMs. That's one option. You could bring in a sort of a random forest model to try to look at the decisions that people are making and the type of transactions that are happening within that. So that's the way I do it at sort of conceptual level. The nice thing about like a Tookitaki type system is you're able to do that distributional analysis and that analytics all together, and then look at all the different type of typologies that have already come up, and use machine learning to find new typologies that may be emerging with these new different payment methods. And again, like I said, I think the changes will continue. I think this is going to be a process that financial institutions will have to continue to do and continue to innovate, because we don't change, or we're continuing to change. We're not going to stop. We're going to change our behavior. Who knows what's going to happen in 2021? 2020 was so weird, and so financial institutions have to keep up. I don't know, Nikhil, anything else to add to that thought?
I wanted to share a quick story. We keep talking about change in behavior, but it's important to note, particularly during the COVID era, and when it comes to cash-intensive businesses, we actually should be monitoring for no change in behavior. Because think about a restaurant. You'd be having all of these cash sales, and if you're seeing those same flows when you have an empty restaurant and you have minimal takeaway or online orders, so you almost need to be sense checking and thinking counterintuitively, and that yes, we do want to be monitoring for the changes in behaviors, but the changes here are that there is no change in behavior. So I couldn't help but share that anecdote.
No, and that's exactly, if I might add, that's exactly why the peer grouping and the clustering is so important, because if your whole peer grouping is changing in one direction, you're staying the same. Well, right. Either everyone else is doing something weird or odd, or you are, right? And the easier conclusion is that you are. No, that's spot on, and that's why those peer comparisons are so important.
And I think the important thing, Dustin, you spoke about really in terms of using unsupervised machine learning in terms of discovery of new patterns. And the important takeaway for me really is that unsupervised machine learning ends up guiding your supervised machine learning models. So Abhishek, when you spoke about Tookitaki capabilities and certainly some of the random forest and other tools that help investigators, I think there's huge benefit in terms of Dustin, as you spoke about, clustering, k-means, peer groups and cohorts. These actually help influence and guide your supervised machine learning models when it comes to the whole risk prioritization and investigation triage component.
Thanks, Nikhil. So one of the follow-up question to Dustin that has come up is, we discussed about what the banks can do from a pure technology point of view, but the question talks about what's the view from a regulatory point of view. With these sort of new NPMs coming up, are there regulatory changes that are being brought in to kind of enable adoption of new technologies in this space? Like, how is the overall regulatory changes being taking place, specifically now that the NPM volumes have dramatically gone up?
Yeah, I can speak. It's a really good question. There are a lot of changes that have been proposed. I know, honestly, most of what's happening right now is just through guidance. A lot of regulators are putting out guidance and sort of, like FinCEN did last year, saying, no, all cryptocurrency exchanges are fully covered. They are covered, their money services business, their money transmitters, and that's just guidance. There has been various proposals that have gone before, again, focusing on the United States right now, because that's what I'm most familiar with, various proposals to further regulate NPMs, maybe even to regulate third-party processors. I'm not sure that that's going to go very far. So there are a lot of proposals out there. Most of what I'm seeing right now is in the form of guidance saying everybody's covered, most groups are covered, and giving financial institutions flexibility, but still working through the traditional financial institutions. It's hard for me to predict what will happen, from a legal or like real regulatory standpoint. I don't see anything, given the current environment. There's not very much focus on making new laws in this space right now. I think we'll continue in the same vein in the short term.
The quick thing to add here is there's no uniformity in risk. I turn to the most recent guidance in terms of PEPs, where the regulators have come and said that, hey, not all PEPs are bad, right? So that's going to really change the dynamic, for instance, in terms of customer risk rating models, where we can no longer assume that, PEPs are bad. So it's really about looking at the data and taking from the guidance and making sure that you cross-validate, what's there in terms of your portfolio.
Thank you. I think that's all the time that we have for today. Thank you, Nikhil and Dustin, for your time. It was such a great panel, and your expertise in the AML space was surely helped me, and I'm sure the audience also really enjoyed. On behalf of Tookitaki, I would really like to thank you and all the audience for their active participation. I'm seeing a lot of more questions coming up. We would definitely make sure that kind of answer them and send it out. All of the audience will receive the key learnings and the webinar clip as a token of appreciation. Please do keep out a watch on your emails. We look forward to conducting similar thought-provoking and innovative sessions in the coming months, and would love to get your support and participation. Thank you again, dear panelists and audience. Goodbye and have a great day. Thank you very much. Bye-bye.
Thanks.